Hey investor friends, I'm Michelle Marki, and lately some of my friends have been asking me, am I in a buying mood these days or am I more so waiting in cash? And what some of my friends are referring to is whether I am actively investing, like buying stocks, or if I'm holding back a little bit and hedging my bets by retaining some of my assets in cash. And so I'll talk about some of what's going through my mind right now as to how I might be investing in 2023, because it's sort of a mixed bag. It's sort of like you want to be a little bit cautious because there could very well be a legit recession on the horizon this year, or everything could be totally fine. And it's like during the summer when it looks like there's some dark clouds and then they just kind of pass you by and then the sun comes out and everything is happy again. But until we know for sure how things are going to shake out, I'll tell you a little bit about what's going through my mind. And if you also enjoy learning about investing and watching my personal finance journey, I hope you'll like and subscribe to my video and YouTube channel because it greatly helps out and it lets me know that you appreciate my content. So thanks. So if we look at some of the latest headlines in the news, we might see that the US economy is cooling a little bit entering this year, where in the fourth quarter of 2022, GDP increased by 2.9%, which seems pretty decent actually. That's kind of the normal amount of increase we normally expect from the US economy, between the 2 to 3% growth rate. And that's actually kind of welcome news that both the third and fourth quarters were positive GDP growth rates compared to the first two quarters of 2022, which were slightly negative. So even though we seem to have been flirting with recession last year, it didn't quite manifest. But apparently a bunch of leaders are kind of worried about a recession coming along, and there's some signs pointing toward that, like increased corporate layoffs, so more people are losing their jobs. And also some leaders have projected that some people's spending will be winding down, and people like Jamie Dimon of JP Morgan Chase have predicted that the consumer will kind of run out of spending by around the midpoint of this year. So that's something to be on the lookout for, because if people start being depressed and consuming less, so they're spending a lot less, that means that the US economy's growth could slow down substantially in the coming months. So I would be on the lookout in the spring and summer this year to see if we really grind to a halt as far as economic growth, because that could help tip us into a recession. And then that might also cause fear in the stock market. So it's not necessarily that you see a stock market decline accompany a recession, but oftentimes they do go hand in hand. So even though right now the stock market based on the S&P 500 had been back in the 4,000 range, which is pretty good. Like that means that the stock market only declined by about 16 or 17% from its previous all-time high of 4,800 at the end of 2021/beginning 2022. So really the stock market is not down by all that much. So in many ways, it seems like even though the Federal Reserve is helping to try to tackle this issue of inflation, and by hiking interest rates, that's kind of knocked down the stock market, it hasn't caused so much fear to make the markets really capitulate. So I kind of think that there's some other boogeyman hanging out there of something else that could cause mass fear in the stock market, whether it lies in corporate debt or national debt. There could be some crisis lurking out there that we've yet to see. So even though I don't know what the black swan could be, for now, we're kind of just going about business as usual, where the Federal Reserve has been doing a decent job of tackling inflation, where after having been at 9.1% CPI inflation in June 2022, it's come down to about 6.5% recently, which is not bad. Like they've done okay at bringing it down by about 2.6% by hiking rates to the current Fed funds rate of 4.25 to 4.5%. And it's pretty much a done deal that we're going to be seeing the next Fed funds rate go to 4.5 to 4.75 by the end of the February 1st FOMC meeting. So that's something that we can look forward to, of higher interest rates in our high yield savings bank accounts. So a lot of them, as I pointed out in a recent video, are at about the 4% range, and that's bound to go up the more that the Fed hikes rates. And then most likely we'll also see the Fed funds rate reach even 4.75 to 5% by their late March meeting. So I'm looking forward to the upper limit of that 5%, because that would actually be a pretty nice interest rate in your bank account compared to how the stock market has been just kind of going sideways. So if you don't want to be kind of at risk in stocks right now, I think it's kind of compelling to bulk up on savings where you're getting a pretty decent return at pretty much almost no risk. And of course, this is not advice, but this is kind of like what I would do, of how I'm kind of looking at things. And with some of the cash that I am holding on the side right now, I am definitely plunking that in some higher yield savings rates, like of at least 4%, because you might as well. It's kind of like free money from some high yield banks, as long as they're FDIC insured. And if you've read up on them and you've gotten some decent reviews, like it usually helps if you've gotten some word of mouth, like your friends or family have opened certain high yield bank accounts, and then you might trust that better as opposed to just random people online saying whatever they might say about a bank that may or may not give you a realistic perspective of some bank offerings. But that's sort of what I'm thinking about as well, given current conditions of a stock market that by and large, in my opinion, is still somewhat overpriced, like based on some indicators that I like to use, like the Wilshire 5,000 overall market cap to US GDP. By some measures, that's come down considerably, like on the official FRED website, where it's come down from about 250% at the end of Q4 2021 down to about 190% as of Q4 2022. So even though it's come down about 60%, that's still 90% overvalued compared to the historical, let's say, fully valued 100% that Warren Buffett considered the market. So ideally, you would look for the stock market being at only 60 to 80% of US GDP for it to truly be on sale. And the fact that we're more than double that amount points to me that maybe we're not quite on sale yet. And this is also backed up by another example of the Buffett Indicator on Current Market Valuation, where if we look at that website, we can also see that based on their metrics, the Buffett Indicator is at 164%. So that's still 64% above the historical trend line and the market being fully priced. So it seems like we're kind of coming down the hill of having been at a place where we were bubblicious during the pandemic years, and it's come down somewhat. And there have been some stocks that have been on sale. Like if you've done your homework and studied a bunch of stocks and you have your wish list of stocks that you like especially, and that you feel like confident, you know what a good buy price is, then there have been some opportunities. Like I can tell you a little bit about kicking myself for kind of missing out on Netflix when it was in the $170 range, and that's doubled now. So many of us could have doubled our money if we had really invested in Netflix, but who could have known? Like I actually at the time back last summer thought that maybe Netflix had some more down to go, but there it just shows that I might not have known enough about the company Netflix. So while I didn't pull the trigger in investing in Netflix, it gave me a lesson to learn about my error of omission, which means to have missed out on a potential opportunity of investment. And it could have gone the other way too. I could have committed an error of commission, which would have meant that I invested in something that proceeded to go down. And then if I would have freaked out and sold out of that, that would have not been great either. So, all in all, I'd rather be a little bit more conservative and have truly studied some things instead of just going full in on something that I may not have had the most conviction in, because that's where a lot of regret comes in, when you just kind of go headlong into something and you're not fully sure where things are going to end up. But yeah, in addition to that, another warning sign is when we have an inverted yield curve. And in particular, we would compare the US Treasury bond return rates between the 10-year Treasury bond and the 3-month Treasury bond, because that's historically been a strong signal of whether a recession is coming around the corner. And it's happened before, like in 2019, before the 2020 recession, and also in prior times, like leading up to the dot-com bubble crash and also the great financial crisis. So it's a pretty decent indicator. And the spread between the 3-month and 10-year Treasury bond rates has been super negative and widening. So it's so steep that it almost seems like a done deal that we're going to have a recession. And who knows how severe the recession is going to be, but this is one of the biggest bellwether indicators of what could be coming. So it is no surprise to me that a lot of super investors that I follow are holding onto a ton of cash, including one of my favorites, Warren Buffett of Berkshire Hathaway. And I'm pretty sure they have over $100 billion still that they're kind of sitting on. And even though they reserve about $30 billion of that in case of emergencies, like for insurance claims, by and large, they could invest the remaining $70 billion. So I'm curious to see if Berkshire was at all aggressive in the fourth quarter of investing heavily in anything in particular, even though I know that Berkshire put about $4 billion into Taiwan's semiconductor manufacturing company, but Buffett would actually have a little bit of a tiff with the Wall Street Journal for saying that Buffett himself bet big, because we don't necessarily know if he was the one who actually invested in TSM, but it's a possibility. It could have been either Buffett himself or one of his investing managers, but nevertheless, it's a pretty big bet that Berkshire did make. And so I'm actually looking forward to studying if Taiwan Semi might actually be a potentially good investment. So that's on my radar to see if I can understand semiconductors more, as I've talked about in a previous video. And also, like I've talked about in previous videos, if you're feeling more conservative and might not want to take too much risks in the stock market, another possibility you might want to consider while inflation is still high is called the Series I bond from the US Treasury. And if you visit treasurydirect.gov, you can see that the current rate is 6.89%, and that's come down a little bit from the previous rate last year that was pretty good, but 6.89% is not half bad. That means if you invested $10,000 in a Series I bond, after a year, you would get about $689. And then if you were to redeem the Series I bond, you would give up 3 months worth of gains if you redeem it before 5 years. So in holding it for at least a year, which is required, you would net 5.17%. So all in all, that's not terrible, but it's getting a little bit competitive with high yield savings rates. So by the time it's March, I think there's a very good chance that more reputable banks will be offering the between 4.5 to 5% range of interest rates. So you may not even have to plunk as much money in a Series I bond if you want to have more liquidity in a high yield savings account instead. So those are some of the things that I'm thinking about doing myself. And while it's tax return time, apparently we can get paper bonds if we use our tax refund to buy Series I bonds. So it may not be that I get a refund, but if I were to get one, I might consider getting paper bonds just for the novelty of having, maybe an Einstein lying around in a Series I bond, but not necessarily required, just sort of something that I find some entertainment value in. So if you found this video helpful and you enjoyed listening to some of my ideas of what I'm thinking about, or some potential tips that could help you or people that are close to you in their own personal finance and investing journey, I hope you'll like and subscribe. And if you have any questions, let me know in the comments. I'd love to hear from you, what's going through your mind as well. And I hope you have a great rest of your week. Till next time.